What I want to talk about is a little bit of the framing and the context for DeFi. Not necessarily go straight into sort of like the nuts and bolts, but try to understand the correct macro environment in which it's happening so that we can kind of have a real conversation about it. And so that'll go through, number one, fintech progress to date, sort of what is the early stage entrepreneurship innovation journey that we've been in that has resulted in what 2020 looks like. Number two is I want to talk about the crypto maturity curve and how we see industries change over time and change at the core and what's really required for that to happen. Number three is talking about the DAOs, the decentralized autonomous organizations of financial services, and really thinking about what is the right comparison? What is the right metric to which you should compare DeFi? What is it really? So we'll start with fintech. We'll start by zooming way out to global GDP. And global GDP has shifted over time in terms of its composition. So you might not be able to see it, so I'll walk you through it. And so the story about global GDP is that manufacturing as a percent of economic activity has been going down, and services, professional services, and financial services have been going up. And so now, if you look at our economies, broadly speaking, somewhere around 20 to 30% of our economies are finance, both in terms of investments and asset management and banking and deposits and lending and things of that nature. And that is true across the different countries. So whether you are in France, Japan, or Sweden, you're going to be looking at very similar stories. Number two is, over the last decade, we've had really an unprecedented shift towards investing in early-stage fintech. And so if you look all the way back to 2007, there was about 50 billion in early-stage venture investment, and about 5% of that was in financial services. And then if you fast forward to 2019 or 2018, you're going to be at 200 billion in venture investment and about 20% in fintech and financial services. And so you've had this kind of equilibrium going back to GDP levels of finance, going out of venture and out of early stage investment. And so it's never been easier to start a finance company than over the last decade. We're all acutely feeling this with the apps on our phones. Some of you might recognize this graphic. If you're fintech entrepreneurs, you'll remember this idea of startups unbundling the bank, attacking the bank, right? So this is Wells Fargo and lots of different companies thinking about how to pull different functionality and build companies out of it and around it. And so today you might recognize some of these names. You might recognize Betterment or Revolut or Covestor, etc. And so it was this idea of use all the venture funding to unbundle into lots of little features. But today, we're on the opposite side of that journey. So today, we're in the rebundling phase, where lots and lots of features turned into fintech companies weren't able to sustain themselves, and now have gotten to sort of this outcome where vertical fintech champions exist in different geographies and have all the features rebundled back in them, right? So whether it's Revolut, which is banking and trading, or N26, which is investing and wealth management, or Betterment, which is wealth management plus banking, no matter what you take, there's a rebundling again into these large multi-million user footprints. And the large banks are there too. So it's not just the fintechs anymore. The fintechs had their chance. Now the large banks offer the exact same thing in the exact same package, whether it's Marcus by Goldman Sachs, whether it's the robo-advisor from Schwab, or something similar. And then the large tech companies are in the game as well. So the last decade has seen more and more companies, whether it's Apple or Facebook or Amazon, launching financial services. And there's still this sort of like naive question about, are the tech companies going to offer finance? That is naive because the answer is yes, it's happened over the last decade, and there's dozens of products that they already offer. And so, economics lesson, when supply goes up and demand is constant, your price is going to fall. So price has fallen across financial features. If it's digital wealth and investing, your price has fallen from 1.5% to maybe 25 basis points, 0.25%. If you're talking about FX and money movement, if you use TransferWise or if you use Revolut to use money, to move money across borders, price has fallen 90% or more. And this is all, we're not touching crypto, we're not touching blockchain, we're just talking about regular old boring fintech. And not only has price fallen, but the features that used to be separate are now all blended together. So you might have thought about chat in one app, and then money movement in another app, and banking and saving in another app, and lending in a different app, and all of that is just coming together, right? So whether it's Facebook chatting money to somebody, whether it's investing and saving and banking in the same app, all of it is just living in your phone. If you are from Asia or from most of places that are not the UK or the US or continental Europe, you already know this because you have super apps, which are the containers for lots and lots of features. Not only features across financial services, but also features like ordering a car or getting food delivered to your home, right? So super apps are the operating system in which all this stuff lives across the world. And this is something that, of course, Facebook is envious of and is trying to build with their own cryptocurrency. So what's missing? We know the story. The story is that 25% of the economy is financial services. Early stage venture used to be 5%, and now over the last decade has filled everything up again. It's never been easier to build a fintech company than now. Lots of bundled stuff is there for us to take. Everybody says we're going to democratize access to financial services, and nothing has changed. Nothing has changed. You bank with the same banks, you consume the same deposit products, you invest in the same things, they are settled in the same CSDs, you take insurance from the same carriers. Goldman Sachs and JP Morgan and Schwab and BlackRock are the winners of the fintech wars, and things are for sale and going belly up in the fintech world. Nothing has changed. And the reason nothing has changed, and this is sort of my core, it's not a discovery, it's probably quite obvious, is that we've all been focused on the distribution level of the industry. That means we've been focused on the store. Distribution is your bank branch. It's the financial advisor. It's the lending officer and the insurance salesperson. It's the restaurant that serves you the food, right? If you change distribution, you can make it more efficient, but you're not actually working on innovating what you're making. You're not innovating on the thing itself, the manufactured product. There's been a bunch of stuff in the value chain, in the middle office, about making things more efficient, 20% faster trading, 20% faster CRM, et cetera, et cetera, et cetera, but nothing really at the manufacturing layer, making the deposit account, making the insurance policy or the lending product. And so if you think about all the other sort of cliche venture capital examples of disruptive technology, all of them required the thing that is manufactured to actually become free at the margin. You can only have Spotify if the music file is digital. You cannot have a Spotify of CDs. It does not make sense. It's nonsense. Revolut is a Spotify of CDs, right? You can't have Google without manufacturing all content on the web for free at scale. You can't have artificial intelligence-driven Netflix without a massive supply of digital movies. And so the question is, what is happening for finance that is equivalent? That is the missing piece for the industry to actually change in a fundamental way. And I think being here at this conference, many of you probably share my view, which is that open source programmable blockchains are that transformation that can happen at the manufacturing layer across all asset classes. And so whether that is sort of the composability of blockchains or the digital scarcity of the assets that sit on top, or the native communities, or the embedded markets, or the built-in compliance tools, any of these attributes that you want to pick, we have an opportunity to have a single rail across all these different asset classes that I've mentioned. And so what I want to take you on next is what I think the steps are to get to the other side, right? How do you fix that manufacturing issue? And you don't start from the end. Well, that's not necessarily true. Different companies have different risk tolerance, and they do this in different parts of the maturity curve. So for ConsenSys, we have a large consulting arm for enterprise blockchain, private Ethereum, as well as public Ethereum. And so one of the places that many people do digital transformation is just at the data layer. So using blockchains to just share account information, right, in an industry, to mutualize the basic data. And then once you have the data, you can start thinking about building workflows on top. So you're actually moving that data around or opening accounts or doing shared identity, things of that nature. And then once you have workflows, you want to apply the workflows to something. So you want to have some sort of bucket or token or hyperlink to the real world. And in the very beginning, the tokens are fairly naive. They're just a wrapper for something. They don't have any content other than to point at human relationships, legal relationships, and contracts. But over time, more and more information becomes written into the token itself, such as dividends or governance or transfer whitelists and blacklists. And eventually, the software that is applied to the asset class, and I'll go through this in more detail, the software that would be traditionally applied to the asset class as an abstraction, trading software, for example, is embedded into the actual network on which it travels. And this gets you to DeFi and the actual financial economy that we're all trying to work towards. So the first step is, like kind of a narrow step into this world is regulated asset classes like private equity and municipal bonds, letters of credit, commercial paper, so things that have a difficult infrastructure which can be solved with transformation projects. And so these are some examples of industries that we're focused on. So there's a number of different asset classes that this is applied to, and STOs, and the idea of tokens having some sort of smart functionality that has capability built into it, whether it's validators or transfer restrictions or ability to live inside of trading systems. But this is really just the start. The real interesting thing is happening on the Ethereum mainnet, on the public chain. And so this is one of my favorite charts about Ethereum. It's a chart that says people are using smart contracts. People are actually using Ethereum as a computing platform. So thank you, Coinmetrics. But you can see 2 million contract calls over the last 2 years, only increasing over time. This is use, it's not price. This is a chart that shows you what those applications are that are using the smart contracts. You can see along the very bottom, and kind of going forward out, are users. So lots and lots of users going in this direction, and then the red and the orange are value. So these are lower user apps, but much higher value exchange. And the red and the orange are decentralized finance and decentralized lending. So you can see that the actual activity and value exchange is happening right in those two corners, in those two areas. And so this is a map of decentralized finance in 2019. Early map of the internet is to the right. 1970s internet is to the right. So you're just starting to see that network actually light up and generate economic activity between different types of actors. This is that same network today, and a map of the internet in 1998. Not 2020, 1998. And so you can start seeing, for example, stablecoins being generated on the right, being sent to lending protocols in the middle, being sent to decentralized exchanges all the way on the left, and the whole thing interacting and repeating. And so that's kind of the chassis of the story, right? We've been missing the manufacturing bit. Blockchains and decentralized finance are the destination of how you could manufacture financial instruments on Web3. And this is happening across all the different asset classes. So many of you know this diagram. It's all the logos of the different companies that are involved. But the interesting thing to me is actually figuring out what you should be using as comparisons in your mind. It's not Apple equity, and it's not the bond, and it's not money. Let someone else fight about what is money and what isn't. It's the actual enabling infrastructure on which the asset class is manufactured. So you have to sort of like me, be like a real, you have to enjoy this like horrible finance geek thing to make the comparison. But I want to anchor you in the types of companies that are the equivalent. Again, forget the asset class. Think about WorldPay. WorldPay is a $35 billion company that was recently acquired. This is a beautiful screenshot from WorldPay. You can see that the lock has a drop shadow, which is very modern design. And it's a payment processor. It enables people to pay securely for the various transactions that they do. On the right, you have the Web3 payment processor that enables people to make a payment transaction with whatever merchant they would like. MetaMask is WorldPay. Core banking. What do deposits sit on? What do you need to let people save, earn an interest rate, feel secure about their money? Right, this is Jack Henry. It's a beautiful interface from Windows 1995, I believe. That's the most recent screenshot I could find. And Jack Henry is what about a third of the American banking system sits on, right? Essentially, Maker is creating the type of currencies, creating the savings accounts that a Jack Henry would power in the older system. Lending and underwriting, Finastra. It's another company that's about $5 billion in private equity. That is a screenshot of its most recent asset-backed lending cloud. So if you're managing a book of loans, this is the screenshot you'd use, basically Compound. InvestNet, portfolio management. You want to run lots of portfolios, you're a financial advisor, you want to understand all your accounts, rebalance, trade, and so on. Some of you might know the SET protocol with their token sets offering, or the recently launched PiDAO, which does asset allocation on Web3. $5 billion in enterprise value. Most of you, I assume, are familiar with the NASDAQ. Again, really beautiful interface over there. Derivatives, right? So if you're watching synthetics, or if you're watching the generally derivatives on Web3 coming out, you can think about the exposure. You can sort of get lost in, is this a good investment or not? Or you can think about something like TradeWeb, which is a $10 billion company enabling people to trade derivatives and supporting those marketplaces with technology. So for me, those are the really interesting comparisons. It's manufacturing. It's the factory. It's the thing that nobody wants to do because it's boring and you don't want to read about it. And that is the thing that fintech has not done to date. And so all of this is going to be, I think, aggregated across beautiful user experiences. We already see this with companies like Instadap or Argent. But I don't think it's necessarily going to be the crypto players that are going to get this first. So this is a chart of B2C fintech companies that have million-person user bases, right? So many of the names I've mentioned already. So N26, Revolut, Chime, Circle, SoFi, and so on. These companies are on fire and need new revenue. And as some of you may know, Square Cash generated something like 150 million of revenue out of crypto trading last year. So it is these fintechs, not necessarily these new aggregators, that are going to sit eventually on top of the Web3 infrastructure. They have the span and they have the rationale to do it. I also think this one is something a lot of people in the industry are missing, which is crypto networks are something that makes sense as a public network from a government provider. So for example, In the United States, about 55 trillion of notional volume went through the automated clearinghouse. That's how people get paid. That's how they send transactions. 55 trillion is a little bit bigger than what we're doing through DeFi today, and it's a public shared network, public and shared protocol. Similarly, if you think about mortgage origination and the provision of credit to people, massive share of that is through federal agencies provided by the government. So I think it's actually, if we find a way to channel this volume through new infrastructure, we can have a pretty fantastic outcome on the industry. And so that's the story. I think it's an amazing time to be in our space because the story is incredibly obvious, but it's also really difficult, and it's easy to miss the forest for the trees. And so hopefully that gave you a little bit of context in terms of how I think we can get to the other side. I'll give you just a little bit of a flavor for what ConsenSys is doing in the space. We're an ecosystem player for Ethereum, and so I'll just touch on a few things that we do. Number one is in decentralized finance, we do a data play through an API. So we look at all the different protocols and kind of unearth insights about what's happening. One of those insights is a risk management system called the DeFi score. And so if you start thinking about credit ratings and the different types of risks that are inherent in protocols, the DeFi score is a way to do that algorithmically and to kind of unearth issues in real time. We also do network launches for companies that have sort of real governance issues or real ways to use tokens within their community. And so one of the novel things that we do for the network launches is an idea called proof of use, where unless somebody's using the token, they're not able to actually withdraw it. It just won't vest. And then, of course, we are involved in digital assets. And so whether it's real estate funds or kind of the different asset classes that I mentioned, that's all along the way. So hopefully that gave you a macro context for why this is a really interesting space and a really interesting moment. And if you want to learn more about what we're doing, check out codify.consensys.net. Thank you very much.